day everyone, and welcome to the premium video newsletter for June 28th, 2013. Starting with the fundamentals, two reports were released today. The first report was the Chicago PMI, which is a closely watched index of businesses in the Chicago area. The index had its biggest monthly drop since 2008. The Chicago Business Barometer sank to 51.6 from a 14-month high of 58.7, which was made in May, just a few months back. That was well below the level of 55 that economists were expecting. The second report that was released today was the Consumer Sentiment Report. The report is released by University of Michigan, which said its index dipped to 84.1 in June from 84.5 the previous month. But that was still relatively high. May's reading was the highest since July of 2007. So the reading was one of the highest in 6 years, which is very impressive to say the least. So as you could see, one report was very bullish and the other report was fairly bearish. The stock market was very mixed today, but is definitely beginning to show signs of weakness that we did not see during this entire week. The market sold off during the first half hour and then proceeded to trade higher as the day continued. Truthfully, if I was looking at this market in isolation, I would probably think the market is very strong right now because strong bull markets typically open low and trade higher as the day continues. This is one of the biggest characteristics of bull markets. However, because there are other dynamics involved here, such as the Fed bond buying program, we have to consider all the facts. Technically, the stock market is still looking for direction, and unless extremely positive news comes out next week, which I am not anticipating, I don't believe there'll be much more momentum to the upside. The volume was relatively low, and many traders are on the sidelines right now, especially in light of the fact that next week is the 4th of July holiday, and many traders are taking next week off. I'm expecting low volume and not too much volatility during next week's session. Next week is not the time to initiate new positions in the U.S. stock market. As anticipated, the gold market began ticking north, and I anticipated moving up higher before moving down to the triple digits. Don't be surprised to see this market go to the 1300 level. I mentioned it earlier this week and I will mention it again in case you missed it. But if you're holding a short position in gold stocks or futures, you may want to wait for the rally to end and reinitiate the position at higher levels. Looking technically at currencies, the British pound continued moving lower as well, and I believe it has a bit more to go. You will notice a good support level around the 151 level. Barring any negative international news in the next few trading sessions, I think we will have a soft landing around that area. If you're holding this position short, consider lightening up a bit around the support level. I doubt we will break the 151 level in the next several weeks, especially during this time of year when volatility is low. The other market I want to bring to your attention is the Australian dollar. The Aussie has been declining slowly during the last few months and broke the recent support level slightly below 92. You may be asking why the RSI indicator is not oversold around this area. The market has been going straight down for several months. The answer is rate of decline. The Aussie has been declining slowly and predictably. When this occurs, the market has time to adjust to current price levels psychologically, thereby preventing panic selling. The RSI is not a very sensitive indicator, which is why I like it so much. But when the decline is predictable and momentum is consistent, the RSI will not be oversold easily. Also, because the rate of decline has been fairly predictable and consistent, I'm not anticipating a big jump in prices. Expect a few weeks of consolidation around this area with mostly range-bound trading action. Looking at our new position, we are now short Walmart, the biggest discount store chain in the US. The setup and the trade so far are textbook tail gap. I may even use this graph for demonstrating the tail gap to beginners at one point. Leave your original protective buy stop at the 76.20 level. I'm anticipating taking profits somewhere around the middle 72 level, but I wouldn't be placing a buy limit order just yet, as we have a while to go and this stock doesn't move very fast. Looking at our existing positions, PFE is once again cooperating with us. Don't change anything and keep the 27 buy limit order in. The weakness is beginning to come through, and hopefully we will liquidate this position sometimes next week at a profit. The protective buy stop level should be left alone and should be the same as when we entered the position. The last short position that we're holding is POR. It also bounced off the resistance area as we anticipated this morning. Keep the position short and I will update you next week. Do not, I repeat, do not change the original protective stop loss on this position. It should be around the 3140 to 3150 level. There are several setups for Monday, but I will not take any of them because I believe the market is going to be very range bound due to the holidays next week. My system generated over 190, that's 190 4x4 setups to the short side for Monday, including the Spider, Yahoo, AT&T, and JP Morgan. Take a look at these stocks and see what good 4x4 setups look like. There are only 2 4x4 setups to the long side, so I think you can get a good idea of where the market is going to be headed next week. We are short 3 stocks, so I think we're in a good position for now. Good night, everyone, and I will update you Monday morning. If you have questions, please don't hesitate to contact us. Have a great weekend, everyone.